Living abroad opens the door to new experiences, but it also brings a new level of complexity when it comes to taxes. Many expats fall into the same traps, often without realizing it, until it's too late. So let's break down the most common tax mistakes expats make and how you can stay one step ahead. Hello everyone and welcome to the Tax Gate. Hit the subscribe button and let's get started. We will start with one of the biggest and most common slip-ups, which is not reporting your worldwide income. Living overseas doesn't automatically shield you from your home country's tax laws, especially if the country's taxes are based on citizenship. That overseas salary, freelance income, or rental income from back home, it probably needs to be reported, or you could be facing serious trouble down the road. But even if you are reporting income, there is another critical piece expats often overlook, which is understanding how your residency is defined for tax purposes. Tax residency rules vary dramatically from one country to the next. It's not always about where you hold a passport. It could depend on where you live, where your family is, or even how many days you spend in a country. Misreading these rules can result in being taxed in two places, or worse, being considered non-compliant in both. You might be thinking like, wait, don't tax treaties protect me from stuff like this? Well, yes, and at the same time, no. Tax treaties are meant to help prevent double taxation, but they are not applied automatically. Most of the time, you need to file a specific form or request to claim the tax treaty benefits. If you don't, then you might be paying taxes you legally shouldn't have to, or making filing errors that could flag your return. On the flip side, there are also benefits designed specifically for expats, but many people miss out simply because they don't know they exist. From the foreign earned income exclusion to the foreign tax credit, there are major tax breaks available to expats. But the point is that you have to know and how to qualify and file the right forms. Miss a deadline or check the wrong box, and you could lose the deduction entirely. Now let's say you are wrapping up life in one country and heading elsewhere, or going home. That's where things can get tricky if you don't know what's waiting at the exit. Some countries treat leaving like you've sold all your assets, triggering what's called an exit tax. Some others would require formal deregistration for tax purposes. If you skip these steps, you might get surprising tax bills years after you have moved on. Even with all the right intentions, it's easy to get lost in the paperwork, especially if you've hired someone who doesn't specialize in international tax. Now let's talk about foreign retirement plans, which can be a real gray area. Just because it's called a pension doesn't mean your home country treats it like one. Some countries tax contributions, or even growth within the account, regardless of withdrawals. Check the treaty status, and don't assume your retirement savings are automatically protected. All right, we're almost there. But there's one more mistake that expats, especially freelancers and business owners, often forget about. Living abroad doesn't always exempt you from self-employment or social security taxes. Some countries have totalization agreements that prevent double contributions, but not all. If you are working for yourself overseas, make sure you know what you still owe, and where. Well, those are the most common tax mistakes expats make, and luckily, every single one is preventable with a little planning and the right support. If you found this helpful, give the video a thumbs up, subscribe for more expat tax insights, and drop your questions in the comments. Thanks for watching TaxGate, and stay tuned for deeper dives into these topics in future videos. Living abroad